on our recording software. See, now you guys have a visual on the iPad?
Yeah, it looks great, Jason.
Excellent. Okay, guys, welcome to our January 10th trade alert. Today we're locking in a relatively large profit on the SPY ETF. Now I'm afraid some of you guys probably made about 30 cents less than I did just because it was hanging on to 327 for dear life. Well, I waited all morning to close out our trade, and keep in mind we do close our trade out approximately 30 minutes before noon, so we have time to create all this content and get it out to you. To review the trade from the previous, which was on January 8th, the SPY traveled considerably higher from 325.04 to 326.96 when we closed out the trade for a gain on the underlying of $1.92. We protected this position with an option caller by selling the 327 call and purchasing the 322 put expiring today. The initial cost was zero. The credit from selling the call option financed the downside protection. And upon exiting this position, it cost an additional 34 cents to close out the short call. In my trade, the put expired worthless because it was only worth a penny. I'm going to guess that you guys probably can sell your put option today. Okay, so that was the net return of $1.58 on 1,900 shares, or $3,002. Okay, scrolling down in the trade alert now, we can see our return, which began almost exactly 13 months ago. We started this December 12th during the Christmas massacre in 2019. So far, we're sitting on a 16.8% return in the period of 13 months. And the largest drawdown from start to end of a month is negative 1%. So we're essentially risking $1 over the course of 13 months to earn our clients $16.80. Again, we're not trying to outperform the markets. We're trying to deliver low volatility and safe returns. Okay, now what I'm going to do is jump down to the current trade alert, and then we'll go back to our open positions. If you did take the previous trade, I'll let that get a little more clear. The first step is to buy to close your January 10th 327 call. And again, if you do have value in your put greater than a penny, you can sell to close your January 10th 322 put. Today's trade is an inverted option caller, but it's not a very confident one. We have a maximum risk in this trade of 32 cents per share. Keep in mind, we just pulled in a profit of $1.50, and we can potentially earn 67 cents a share if the SPY ETF come Monday at our new trading period is below 326. Now we can, in truth, make a little more than that if the implied volatility jumps up. So that is our trade today. The reasoning behind it is highly correlated to our balance sheet, the Fed's balance sheet, reversing its trend, which had been to grow by $25 billion a month. And with the update last night, which I was sitting there hitting F5 all evening until they did post it, was somewhat of a surprise. And again, it did decrease. Okay, so let's go up to our other positions, and then we'll jump into the news. Okay, in our open positions, we entered a long position on emerging markets, ETF EEM, and we paid 30 cents to purchase the 44.50 put option. At the time, this was only trading 37 cents below the current trading price, providing ample protection to the downside. And so far, the emerging markets ETF has appreciated by 85 cents. And that's again, that was taking at 11 a.m. The initial option cost was 30 cents, and the current value of that put option is 4 cents. Now, we did not sell any call options. Keep in mind, emerging markets represents 10% of our portfolio, and I do believe it can outperform the SPY as its PE multiples are dramatically lower than the SPY, and we're still not even at the high obtained at the end of 2018. So currently we're up 59 cents a share on 3,800 shares, or a gain of $2,242 since placing this trade on Tuesday. TLT is looking a lot like last week's, where it went against us immediately after placing the trade, which ends up in option assignment and leaves you wide open with a long put. And so our big picture trade on TLT is that it should most likely crash to 120 as long as we are seeing a rebound in growth and earnings stay at least lukewarm. We've seen the stocks getting way beyond earnings, simply driven by corporate buybacks. So traditional analysis of stocks is really out the window in this genre of central banks distorting markets. So we'll deep dive into that in a minute. So far, we entered the TLT trade at 136.03 yesterday. Now, I think that did bounce up a little bit before a lot of you guys got into it. We sold the 133 in the money call option, and we purchased the 138 put option. So we're short the 133 call. In other words, we sold the call option and we purchased the put option. So what does that mean? Well, if we are assigned, we're going to take a $3.03 loss on the TLT, but we collected a credit of $3.25 selling that call option. So the net gain on that portion of the trade, if assigned, is 22 cents. I would not be surprised if we're not into a cash position either Monday or Tuesday, as that call options currently delivered a 50% return and gaining for the buyer, which is perfectly fine. And again, this is what I call the double payday when we do these inverted option callers. Now, keep in mind, with our strategy, by purchasing the underlying asset and then selling a in-the-money call option, when exercised, we end up in a cash position, and we have no longer a short call option or the TLT shares. So you won't buy back those shares until the next Thursday. That's very important, especially when we're not long that position as our general outlook into 2020. So once again, we may end up long a put. And if there's good news going into next week from the US-China trade deal, I think we can see that TLT start to sell off and potentially give us that double payday. Now, even if you're not assigned, you'll get very close to the same return. The previous trade, the only difference for those who were assigned versus those who were not was 10 cents in terms of profit. And yesterday we did pull in a $3,344 profit on the TLT from this exact setup. Okay, the next position to review is GDX, gold. As long as the Fed is increasing its balance sheet and keeping interest rates low, we want to be long gold. And that had been the trend for the last several months. And I do suspect it will continue to be the trend because of the size of the US government's deficit. They're really trapped. And I suspect that this decrease in the balance sheet should be a short-term change, and that they'll be back to adding to the balance sheet in the upcoming weeks. Now, if that's not true, we will have to reevaluate our GDX position. Currently, we purchased the $29 in the money put option expiring February 28th. GDX so far since yesterday has traveled from 28.12 to 28.39 for a gain of 27 cents per share. And the in the money put we purchased traveled lower from a value of $1.59 to $1.38. Our net gain to date is 6 cents, or a gain of $228. Now, the logic behind buying an in-the-money put is that we want to lock in our maximum profit, or rather our maximum loss at the entry of the trade. So if you're just starting to follow us, you will still buy the same strike and the same expiration. And this will give you the setup to potentially return, for my judgment, a minimum of 10% on this position while risking 2.5%. Now, the potential gain on GDX could be considerably greater than that, but this is our strategy for having a low volatility return, playing a very volatile asset, which is not just gold, but gold miners. Only thing more volatile than this in this space would be silver or silver miners, which we're not trading. So once again, our hope on this trade is for GDX to travel greater than $1.59 to the upside between now and February 28th. If it travels up at all, we're earning a profit, but we are paying off our in-the-money put option to a great degree in the early run-up of GDX. So that is the pros and cons of buying that in-the-money put. Lock in the maximum loss, which is 2.5% on 10% of the portfolio. So we can only lose 0.25% maximum between now and February 28th, while I expect we can earn on this 10% of our portfolio anywhere from a 10 to 20% gain. Okay, so that's a look at our open positions. To review the trading plan, again, we trade the SPY Monday, Wednesday, Friday, emerging markets on Tuesday, and then the TLT, that's the 20, 30-year treasury, on Thursday alongside the gold market, which has a lot of the same analysis as the bond market on Thursday. Now, just because we own these assets doesn't mean we think all four of them will go up. We do use options to protect the position and to create profits in different market conditions. And again, today we are just taking a little breather. The SPY has been on quite a run up, and this is the first big drop in the balance sheet. We have to see how the market reacts to that. And also we have to see, has the Fed found the right reserve levels to make the financial system operate without having to add additional, or is it going to require continuing to grow its balance sheet? So it's a good time to lock in all the profits we've been enjoying almost nonstop on the SPY for several months now, and see how the market digests this huge drop of $25 billion in the balance sheet. Okay, let's take a look at some data. And also, if there's any questions out there, please, now's a great time to ask them. Okay, so here's where the Fed updates its balance sheet before it reflects in those charts you always see. So we can go ahead and read the financial statement. And again, this is released at, whoa, let's try to redo that. Here's the chart we're all used to looking at. However, it does look like they update the graph at a little bit slower pace than they do release that H1 report. Let me pull that back up and see if it doesn't go berserkers on us again. Okay, go ahead and close that out. Okay, so here's the most recent report that was updated on the federalreserve.gov, where you can see the chart. Last Friday, we saw a huge slowdown in the growth of the balance sheet. You can see just by looking at the angle of the growth of the balance sheets that have been growing rapidly. We've had a few moments in time where there was a drop. In November, they had a slowdown. And in October, they had a little bit of a slowdown. And it was directly after that that we did see a little bit of volatility in equities. Now, once they do update this graph, you'll see that they have actually decreased this by, now counting in trillions can be a little funny, but ignore the 626 in your head, just look at that 4173 in terms of billions of dollars. So currently, the last report was $4.173 trillion or $4,173 billion. As of last night, that figure has decreased by $25 billion. And so that's the main analysis we do on Friday for a judgment of what might come the following week. And so let's flip over to some charts now. And sure as day, market appears to not enjoy this update. Now, what's odd is the futures market was trading very aggressively last night. So it was only really at the open that we're seeing this trouble. And so this trade's already nearly at its maximum profit, less than an hour of being released. In fact, 22 minutes of being released. So hopefully we all got filled on that. Let's see if we have any questions. I do see some questions popping up. Yeah, it's just remarkable how highly correlated this is. Okay, let's take a look at some comparison charts. Now, I think I'm going to look at a few of, I'm going to look at the Monday trade or comparison chart, which normally we do on Monday, obviously. Let me just fix the, okay, so in this chart, we're comparing, really pay attention to the yellow line. That's the Brazilian stock market. Right now, we're looking at a 1 week chart. And what I want you to notice is that Brazil tends to outperform the S&P 500 when it's traveling higher, but it's also selling off before US equities at a greater pace. And so it can act as a leading indicator for us. So if we do go to a more recent chart, let's go into 4-hour mark. And so we can see, just like clockwork, the Brazilian stock market began selling off well before the US and is giving us a warning sign. So we'll see how much of a sell-off we get into next week. Again, my outlook is to buy the dip, and really it's very finesse trying to call these small pullbacks until we see this chart change direction. Now let me pull off the, let me go back to our default layout. And let's go into 4-hour chart, LQD. This is really the one that must snap before we're going to see any kind of serious long-term pain in equities. And it's just not happening. It's just super cheap credit. So we can expect the corporations will be smiling with a grin as they borrow at 0% rates and turn around and just simply buy their own stock to infinity and beyond with no care. So again, this is the critical chart that must crash before a corporate buyback scheme is broken. And if the Fed's keeping rates low, the chances of this happening are relatively slim. And if the government's creating massive deficits, well, you can expect to have a great GDP print next year. So what breaks all of this would, of course, be inflation. Now, we do our inflation watch on Thursdays, as that's highly correlated to gold as well as to the bond market. Okay, so let's look at some other charts. Let's look at the dollar index now. And again, this is DXY. This is a big basket of currencies relative to the dollar that has a lot of the emerging market currencies involved. And the big high conviction trade from Jeffrey Gundlach was a weakening dollar, although there's some other analysis out there, namely from a guy named Brent Johnson, who's, of course, nowhere near the league of Jeffrey Gundlach or Ray Dalio, but he's been made famous on Real Vision with his milkshake theory, whatever you want to make of that. But his basic thesis is that there's so much debt denominated in dollars overseas that it's keeping the dollar strong, even amid inflation and everything else with the weakening monetary policy, lowering rates and expanding our balance sheet. You think the dollar would be falling off a cliff. And you can see it has been weakening considerably since the emergency meeting in September, which is when the Fed did a web conference. This was not even in person, and they decided to begin massive asset purchases. Now, typically they like to cut rates first, which is very beneficial for banks to unload bond positions. And so if the primary dealers by law have to pick up the US debt and it's starting to fill up their balance sheets to the point where they can't lend, that's why they had to jump into this repo madness. So surely we can see the dollar has been weakening as the balance sheet has been growing, but now we're seeing a little strengthening here. My expectation is this will continue to weaken, that the Fed's balance sheet will continue to grow, and that we want to remain long stocks during this period of time with very few exceptions. Okay, so let's take a look. Let's take a look at Europe now. So we have two different European charts I want to take a look at. First is IEUX. This is primarily your United Kingdom. This is Europe excluding the United Kingdom. So Germany, France, Spain, Italy, all those big name countries. If we look at a weekly chart, we can see a strong recovery in stocks. In a minute, we'll look at their balance sheet, which has been growing. We've recently had Brexit. So we are now separating out the United Kingdom. If you do follow Stanley Druckenmiller, which is part of our boot camp program, and our portfolio is highly correlated to both, to really Druckenmiller and Ray Dalio is really the two core strategies that our portfolio mimics the most. Just we do it with much smaller capital so we can take advantage of options markets. And we can see United Kingdom looking healthy. If we go look at their balance sheet, okay, this is the ECB's balance sheet. Oh, wait, let me get this updated. There it is. And we can see this has grown. Now these are in euros, so perhaps about 10% higher than a US dollar. Their balance sheet is greater than the US, sitting at 4.7 trillion.
Hey, Jason, I think we lost your audio for a second there, bud. Okay, folks, hold on just one moment here. We had a little technical difficulty. We'll be right back up in just a second here.
Okay, can you hear me now?
Yep.
Okay, that's crazy. I wonder, I guess I must have muted myself instead of you. um, okay, great. I did notice we have a lot of people joining in. I think some of us may have missed some of the intro. I will recap what's going on. And I had a gut feeling this morning that we're going to have a sell-off in stocks due to the Fed's balance sheet decreasing in size. We had a market that was addicted to the expansion of liquidity in the banking system. And last Friday, we saw the average go from $25 billion in growth to a de-acceleration of the growth to 10 billion. So that's a 60% slowdown in the growth of the balance sheet, at least in the monthly quantity. As of the update last night, it was a shocking $25 billion drop in the balance sheet, which essentially just means they're letting this repo money that they've lent out roll over and expire and not reissuing it. So this has been highly correlated to stocks over the past several months. And the few times we've had a little volatility in the last several months, last 3 months in particular, has been right after the balance sheet update showed either a slowdown in growth or actually a drop in growth. So the current trade, had I been a little more highly convicted in the trade, we could be sitting on a much bigger gain. But if I pull up that risk chart, we can review. Hopefully everybody got this on in time. And if we do look at that risk graph, is audio sound fine right now? Yeah.
Yeah, sounds great.
Okay, great. So yeah, we really nailed it. We, so far at least, I was watching the SPY just hang on for its dear life to that 327 all morning. It was as high as 327.25. So again, I won't ever take the trade until 30 minutes before noon, which is about how much time it takes to produce the trade alert, get it into the document, roll this out, have proper testing, several eyes looking at it, and then getting this out to our clients. And so today's trade was to sell the 326 call for a credit of $1.37 and to purchase the 327 put for 74 cents. So this created a credit to your account and essentially is a down bet. So we can actually own the underlying asset and take advantage of that by selling an in-the-money call option. And so you can look at this risk graph, and it's pretty simple to understand. The x-axis travels left to right, which shows the price of the SPY ETF in the future. And the y-axis, up and down, shows you your profit loss in the future at a different price on the SPY. And so you can see our profit gets cut off after we go below 326. Now let's look at where we're currently trading at. So just to think about this logically, if you've sold a call option and the SPY goes down, you're making money from the short call. And if you buy a put option and the SPY goes down, you're making money on the put. Now just realize your SPY is going to be showing a loss. The gain from the options will be greater than the loss of the SPY. Now there is a weird situation, which would be very difficult for us to achieve today because there's only today and Monday trading where the trade can go against us initially. We get assigned into cash and end up long a put option. That did happen to our clients on the TLT for at least half our clients and generated a little extra profit yesterday from my mathematic breakdown. The difference in profits was about 10 cents. So not a big deal if you're not lucky in getting assigned. But keep in mind with our program, because of the design, you never are in a position where you wake up one day and now instead of being in cash from assignment, you're in a losing stock position. So that is a popular question. Why don't we just sell put options? And there's nothing wrong with selling put options if you know what you're doing, but it's just a much more aggressive strategy with a lot more downside risk. Okay, so let's go ahead and pop over to some live charts, see what's going on here. So we're getting a little sell-off. All right, guys, let's go ahead and see if we have any questions out there now. But that's the big analysis on Friday. So we did see that the ECB continues to grow their balance sheet, although not super aggressively like the Fed. They do tend to take turns growing their balance sheets, but this is a rare point in time where we have 4 major central banks growing either their money supply, primarily China's method of growing debt, and then Japan, US, and Europe like to do it by issuing government bonds and then buying them from their own central banks, which is somewhat of a joke, but that's the world we're living in. All right, let me go ahead and I'm going to go ahead and unmute the audience, see if anybody wants to chat. Donald, how's it going?
Fine, Jason. How about you this morning?
Oh, doing great.
Good, good. Hey, I've got a question, and it's more specific to me than the group in general, but what platform are you using? I'm trying to duplicate some stuff, and I can't. Are you on TD?
You know, yes, I personally use the Thinkorswim TD Ameritrade phone app to do my trades. But the screenshots that and also you are a bootcamp member, so Tuesday we're going to learn how to do the trades really smooth from the phone app, like really smooth. So that'll probably help you out.
Good, good.
Now the screenshots you see, I use a really super simple platform. I found it's the easiest for education to show the profit loss chart. I've never really seen something that just lays it out so simple and so easy to read. So that's where I take those screenshots. That platform is called Dynamic Trend, and it can connect to a number of broker dealers. I'm not sure exactly which one. It does cost a subscription cost, but I think once we do our module Tuesday on how to place trades, specifically in Thinkorswim phone app, that's the best bet by far.
Okay.
Because we can trade the Forex market, the futures market, the stock market, everything from that single phone app. And it's really cutting edge.
So you're actually using phone app rather than the regular program?
Yeah, I actually prefer the phone app, yeah.
Okay.
But it looks just the same on their web platform.
Yeah.
Now their desktop Thinkorswim is much more confusing and advanced. So,
to say the least.
Yeah, just not necessary. You know, if you want to do some trailing stops and some crazy things like that, and manage a huge portfolio, then all of a sudden that makes sense. But you know, why make your life so complex when you can get better results with less work? So I highly prefer, obviously, our trading method and keeping life simple.
Yeah, well, I'm a simple person. Because we're going to go in that, we're going to do that Tuesday in the boot camp, right?
Correct. Yeah, Tuesday is all about understanding all of the trade tickets, how to fill them out, and kind of like an introduction to all the flavors of how we could alter our trades. And then the upcoming weeks, we really dive really deep into that, trying to understand, what does it mean to be short a call, long a put? How do they work together? What happens as volatility is going up or down? How does time premium play into all this? So yeah, over the next 6 modules, really, you're going to become very fluent in option talk.
Okay, good. Good. Okay.
Any other questions out there today? Let's see. Mark has a question. Mark, I saw your hand up and unmuted you. I think you have to, there you go.
Okay. Yeah. Call me a little bit slow or dense, I guess, but I cannot figure out how to get to the boot camp, and I cannot figure out how to get logged into it or where to find the schedule. Every time I find something, it doesn't seem to align with what you're saying in these phone calls.
Okay. Yeah. We're going to have a boot camp update come out today after this webinar. That'll have all your links handy. So I think once you get that, so far there's 3 modules produced. The first one's the big picture. The second one is teaching you the opportunity to do a futures trade on China. The third module was the opportunity to do a Forex trade in Hong Kong. The fourth module coming out this Tuesday is really just the basics of how to fill out the option trades that we issue and all the different variations of it. So
one thing that, and maybe there isn't a way to do this, and other places I've been, they have a method of this. If I just go to the portfoliobuilder.io main website, it seems like there ought to be a place to click for boot camp, and then members login, and then it should just take me right there to show me all that stuff. And when I go there, I just can't figure it out. Maybe I'm just.
We need to make it easier, but I'll show you how to get there right now. You go to portfoliobuilder.io, and then it's down here. But yeah, we'll get you an easy login button. And then right here is your boot camp.
Right. So when I click on like weekly study or modules, right, this is all the stuff in the past, but where does it say what's coming up, or if there's one today, like, you say there's, Tuesday there'll be one after there. So Tuesday, right after the phone call, I'm going to go here and look for it. And it seems like I'm not finding anything, and then I miss it.
Okay, sure. So yeah, you haven't missed anything. Today you'll get so Friday, Saturday, Monday, Tuesday are the 4 key days bootcamp clients get content. So you'll get the trade update today, reviewing your schedule for the week. Saturday, you'll get your weekend study work, which is typically 5 videos to watch. And again, it does reiterate the schedule for the week. Monday is your weekly Q&A webinar, which you'll get an invite to every Monday morning. And then the new modules release, and again, it does have your schedule in every update. So
can you show me an example of that where it shows the schedule of an update, where it shows the schedule?
Right now I'm presenting from the iPad. So just look at your email today. Okay. And you'll definitely see the schedule. It's in every update.
Okay.
But yeah, this will require a password to get access. And that's also in your daily update. Now we are going to reorganize this to slip in the option trading as module 2 and to push this to 3 and 4 just for organization purposes. But this is what we have released so far. Now it's organized into these categories. So you have modules, you have trade alerts, which we currently have 4 open positions, 2 banks out of England and 2 copper mining facilities, one based in Mexico, the other in Indonesia. And then you have your weekly study, Some people like the weekly study more than anything else. I think Murray's in that camp. This is the best of the best of all the content I've collected over the week to study and give you a little more in-depth. So yeah, we keep you busy. And then the Q&A is completely different. Q&A, we review the portfolio, the bootcamp trades, the module lessons, and it's really a good way to get people caught up. So make sure you join. I know we had an issue I think last Q&A, the invite didn't make it out in time. So you should have had it. I believe you were on this module, weren't you, on this Q&A webinar? Yeah.
I have not joined one yet.
Okay. So yeah, the next one, and I'll make sure you get a resource sheet with all of this so that you can save it. Okay.
Okay.
Okay, great. Tom, go ahead, please.
Hi, I tuned in at the tail end of the toss discussion, and I was going to know whoever that was, they might want to take a look at Tastyworks, because Tastyworks is 10 years newer by the same group. Tom Sosnoff's group did Thinkorswim about 10 years ago, and last year they came out with Tastyworks, which is much newer, has all the things on it, and I like it better. So,
oh, nice. That's great to hear. So
consider that. Plus, it doesn't have any bloatware in it because it's all brand new, and Thinkorswim has been upgraded, and there's a lot of bloatware in there. So, something to think about. Okay.
Oh, thanks, Tom. That's great. The Thinkorswim's kind of like flying a F-35 jet, and we just need a little taxi to get from point A to point B for our trading system. So good advice.
Is this being recorded?
Yes, sir.
Yeah. Okay.
So if you want to watch the recording, the easiest way to do this is to go back to the Trade Alert email after the webinar is over. Give it 30, 60 minutes to process, and then you can click and replay the webinar from the same link that puts you in the webinar live.
Okay. Well, thank you.
You're very welcome. All right, guys, any other questions out there today? Let's see, Oscar, you ready for a little bit of a pullback or what? Oscar's been making sure everybody knows sometimes we underperform a bullish market, but we really shine when the market's going flat or turning around. So this is one of those rare moments, at least in the last 13 months, where we're seeing some signs of weakness here.
Yeah, Jason, you're positioned for it if it happens.
Yeah, at least on the SPY, not so much on the TLT right now.
Yeah, I've got a question on that. How do you value the position on a current basis if it's trading above the 138, which is the put area?
On the TLT?
Yeah.
Sure, let me show you. Okay, so if we go underwater on a trade like yesterday's, here's my math to show us the P&L, assuming we're assigned. Now, after all the time premium has eroded by next Thursday, whether we're assigned or not, we're going to be very close to the same return regardless. So here's a look at the math. We entered at 136.03. I think you guys may have entered a little bit higher. We sold the 133 call. So we're automatically assuming a $3 loss on the TLT because that strike is $3 below the entry price. And then we purchased an in the money put. Okay, so assuming we're assigned because the TLT has appreciated, we can look at the let me see. So on the TLT and the short call, we're taking in a credit of 325, but we're losing 303 on the underlying TLT for a net gain of 22 cents. Now on the long put, we paid 226 and that current value is 85 cents. So this is playing out identical to last week. Now last week, the TLT bounced because of the Iranian attack or escalation. This time, I think it's just simply because the Fed did not grow its balance sheet, which is surely catching people by surprise this morning. So now we're set. We're splitting the trade in half, assuming we do get a sign. So come Monday, we could potentially be in cash on that position, and we'll have gained 22 cents on the combination of the short call and the TLT, and then we're long our put option. So assuming that there is a China deal and these yields start to rise back, we could have the same situation we had on the TLT in the previous week where the trade went against us right away. We get assigned into cash, and then the trade goes our direction towards the end of the week, and we end up with a large profit, which was the case yesterday. Does that make sense? So I'm just splitting it in half. Instead of looking at the option caller as a whole, I'm splitting it into the TLT and the short call, and then looking at the put.
Right. Okay.
So yeah, we're really not, there's not a big enough fear to, the risk to reward ratio on the TLT is a lot different than it was going into the US-China trade war. When we were long the TLT at that period, we knew the TLT was overbought, but for good reason, because it was expecting trade escalation. Now it's stuck in these super low yields, and there's no big carrot in front of it to drive yields lower. There's no chance of rate cuts in 2020, which drives yields lower. And there's no risk of a major trade war, assuming that Trump doesn't want to lose his election. So TLT no longer provides a intelligent insurance policy to be long stocks. So I'll be very timid to be long the TLT until its yields have gotten to a more appropriate level. And we're starting to see foreign investors really pick up the tab on these debts that the US government's issuing. And the last treasury was actually quite strong yesterday, with a lot of indirect foreign bidders picking up. I think it was something like 18 billion in US Treasury bonds. Now, Monday, we will be looking at the auction schedule for the week. So we'll have a good idea of which portions of the yield curve are being sold for the upcoming week, what quantity, and that will give us a good feel for just how much pressure should be placed on the TLT. I wish my link was working. I don't know why it's spazzing out. Let me try closing this and reopening it, see if we can get this. There is some interesting analysis we can do when we look at the details of the Fed's balance sheet, not just the total change. Okay, well, next week I'll just email myself this report so we can look at it better. Oh, man. But essentially what I will summarize for you is that they are actively selling the middle and long end of the treasury curve. They're aggressively selling massive amounts of mortgage-backed securities. And then they are extremely aggressively picking up the front end of the yield curve. So just your T-bills. And so this is essentially, it's almost as if they're trying to accomplish a higher yield on the middle and long end of the treasury curve by design. So they are letting go of something like 270 billion in mortgage-backed securities in the week over week. And they also sold a lot of their, or they allowed a lot of their middle, the notes and the bonds to roll off. And they put every penny they could into buying these 3 points right here, the 1 month, 3 month, and 1 year treasury. And so we can see it is working. Let me go to, since they've begun this process. We can see that yield curve is rising. And as you could argue, they're attempting to do by design. And so what's their end goal? Well, I believe they need to get foreign investors to pick up the tab on the US government debt. They need investors who want to buy and hold the treasuries, not speculate that the Fed will be forced to cut rates so they can just sell them back to the Fed. And so to do so, these yields have to beat inflation, plus allow for the foreign investor to hedge against a weakening dollar, as they'll need to convert these into their local currency. And so this means these yields need to rise. Otherwise, the primary dealers get stuck with the tab. And once they run out of cash, all of a sudden the entire financial system freezes up. And that's what got us into this mess originally with all this repo madness and the growth of the balance sheet. So I think they, by design, want these treasury yields to rise so they can apply less pressure to the US banking system and get this debt out of internal hands and into external hands. And for that to happen, these yields have to be attractive, which they're just not. 2% hardly beats the anticipated inflation. After you have to hedge against currency risk, there's really no point in purchasing these unless you thought the Fed was going to soon cut rates and buy up all these bonds for a capital gain rather than for income. So that's why we're short the TLT and in general, long the SPY. All right, guys, any questions? All right, well, I'll just do a quick recap on our returns. We've been trading for 13 months now. Started during a pretty horrific crash in equities back in December. We have not outperformed the SPY in just total return. However, we have greatly outproduced the return versus risk. Keep in mind, we've lost at most 1% from the start to finish of a month. Never lost capital over a 90-day period. And for every dollar risked in the past 13 months, we've generated $16.80. So our goal is to protect your wealth and carefully grow that nest egg, whether it's for retirement income or just to grow your savings. And we use a very weatherproof balanced portfolio that keeps track of the key markets, which are US equities, emerging markets, the US Treasury market, and then a little extra cherry on top playing the gold market. So thank you everyone for your time. If there's no other questions, we'll go ahead and wrap up today's alert and start doing our research for Monday. If you are a bootcamp member, we'll be sending an update, no new trades. I would love to buy some VIX call options, but not until after the US-China trade deal has been signed. And then probably even a little longer after that. So currently we have 4 stocks, 2 of which are English banks, 2 of which are copper producers. And I do intend to hold that position considerably, most likely for over a year. So thanks again. And let's see, Tom, you still have your hand raised. Do you have another question? Also, if you did join in late, seeing a lot of new people coming in, just go back to your email, give it 15, 20 minutes, and you can replay this entire presentation from the start, and also get access to all our previous trade alerts, track record, whole lot of goodies. So thank you everyone for your time. Really appreciate it. And looking forward to having you guys back on Monday.
Okay, sounds good. Hey, Jason, thank you very much. And Ryan just typed in something. So you guys can actually click and replay it immediately now. So we had a little change up in our technology there. So you can just
Nice.
click on the email and replay it. But Paul, Ben, let's see here, MHOG, MH, MG, Don, any additional questions that came in, folks? I know we covered quite a bit in a short amount of time. I would love to answer any questions you have and offer you the greatest amount of value while we have you here. And it's always better to address them live. Don't be shy. There's no such thing as a stupid question. There's just so much to learn about finance. So just jump in there. Don't be bashful. Let us know what's on your mind.
Thank you, guys.
Thanks, Donald. Appreciate it.
Sure. Have a good weekend, Jay.
Okay, we'll see you on Tuesday. Okay,
You bet.
it's not going to be one of those easy webinars. We're going to be whipping you into some option trading shape here. So,
Okay. Looking forward to it.
my pleasure.
All right, Donald, have a great weekend, bud. Thanks for coming in.
Thanks, Ron.
Thanks, Dean.
Thanks, everybody. Have a great weekend, guys.
You bet. Bye.
All right, Jason, you want to hand it back real quick and then I'll close it out?
Sure.
Cool. All right, guys, and give me just 1 second here. And I'm going to go ahead and add my screen and then we'll finish out here. All right. All right, guys. So if you are on a trial with us, I want to just express once again that many of our members make more than the cost of our membership during their trial. And the trading plan is going to take less than 2 minutes to execute at noon Eastern each day. Okay, so love to do that and love to just offer you all the most value possible during your trial. That way it's easy for us to build some trust together before we ever ask you for a service fee. And we've been able to do that with over 1/3 of our customer base. I don't think there's another publisher on the planet that's been able to do that. So thank you for taking the time to join our daily webinar. Enjoy the education and ask questions. Okay. We truly appreciate your time and attention to show you how boring successful trading can be when you actually have the right strategy. And touch on one thing real quick. And also, guys, here's my phone number, 505-322-7515. If you have any questions after the presentation's over, just give me a call. I'd be more than happy to work through any questions you may have. And obviously save this number or just, write it down and tape it to your computer. That way, any questions that come about as you watch replays or go to our YouTube channel and continue to study what we're doing, just call me at any point. I'm more than happy to address questions. And if it's over the weekend or, if it's late on a Friday, hey, just call me. As long as I don't have something pressing with the family, I'll be more than happy to get with you so we can help you understand what we're doing. Okay. And folks, want to go back to this. I know I show this a lot, but really it's been such a good rule for me and I've absolutely mimicked this. But really the whole strategy is based around the core philosophy of Warren Buffett's 1 and 2 rules. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. And I think the coolest thing about the portfolio, guys, is literally by this time next week, you can establish a hyper defensive portfolio, okay, and completely eliminate business risk by owning a stake in 1,500 plus companies with just 4 ETFs, okay? And yeah, you can still do your high risk stuff and your high alpha stuff, and that's fine. Do that with a portion of your portfolio, but really, folks, with the core base of your capital, it just makes so much sense to be defensive, to be set up to make money in really any market situation. And literally, if World War III starts tomorrow, we're going to wake up with more capital on Monday than we are today with the way the portfolio is structured. It's just how it works. Okay, it's really cool. Daily live presentation. You guys came today. Thank you very much. I would love to see a little more interaction and a little more questions. So, and if you guys have any before we close out here, please just jump in, unmute your microphone, or type in the chat box. We'd love to get to those for you. Okay. You can always review our track record. Just go to portfoliobuilder.io, scroll down to the very bottom of the page and click track record. Super easy. And folks, here's the target allocation, right? So we're going to trade SPY Monday, Wednesday, Friday like clockwork, unless there's a market holiday. We will have one more market holiday coming up here this month. So we won't have a Monday trade on MLK, but so what we'll do is we'll just actually push that option expiration out to the Wednesday following. But outside of market holidays such as that, we're going to trade Monday, Wednesday, and Friday on the SPY like clockwork, Tuesdays, EEM. Okay, which is also written up as one of the biggest alpha trades for most of the tier one banks that are out there. That's a huge position for them. So it's not too late to get in that. We still have tons of room to run. SPY is absolutely not too late to get into as well. And guys, I get a lot of questions about worrying about buying in this high to the market. Well, look, this is why you have the TLT and the GDX. You buy that protection right away, and within a week, you literally have all of the protection you'll ever need for your portfolio. Okay, our target income, if you use $300,000, is going to be $3,930 a month. Okay, per 300,000, that will more than pay for the cost of the membership in no time at all for you. Okay, if for some reason, guys, you didn't get today's trade alert, please send an email to ryan@portfoliobuilder.io. Or if you're not getting text message alerts, that means you probably signed up with your landline or maybe a business line or something. Just email ryan@portfoliobuilder.io to make sure you get that. So before we close out, is there any last questions here, folks? Let me go to the chat box again, see if we have any last questions. Okay, it doesn't look like we do. Anyone else? Going once? Going twice? Sold. Just kidding, guys. Please feel free to reach out to me if you do have additional questions. I'll put my number up one more time. And that number is 505-322-7515. Look forward to helping you give your capital the protection it deserves. Okay. I'm going to help you sleep better at night and help educate you on just how the entire financial system works. It's pretty funny. So many people look at all these hocus pocus technical indicators when really it all comes down to the financial system and the macro environment. So we look forward to educating you on that, folks. Protecting your assets and slowly but gradually increasing your nest egg that you've worked so hard for. Thank you, folks. Jason, any last questions, comments, bud, before I close it out here?
Nope, good on my end. Thank you so much, Dean.
All right, folks. Well, thank you so much for your time. We will see you Monday.